A glut of oil, and not many places to put it, has been punishing crude oil prices. In fact, sending crude into negative territory for the first time ever yesterday. Although negative by about $4 this morning, believe it or not, that is well off the lows that we hit yesterday when we were down by $37, meaning you had to pay somebody $37 to take oil off of your hands. Now traders are searching for any signs of relief in the near term. To talk more about this, let's bring in Rob Thummel. He is portfolio manager at Tortoise. And Rob, this shocked just about everybody. We knew that things were bad, but to watch people panic as you were getting closer to the delivery date today for that May contract, maybe it's better to look at what's happening for the June contract, which still is under some pretty significant pressure. Last I saw, it was around $16. What's happened here? What would you do in this scenario?
Yeah, well, basically yesterday you had a bunch of, obviously in oil markets, you have physical buyers and you have financial buyers. And in this scenario, we had a scenario where these financial buyers were going to become physical buyers at the end of the contract period. And they had nowhere to put the oil. So they just had to unload their contracts, and that just created a lot of selling pressure, and there were no buyers. And so that's where we ended up. And so what obviously that clearly indicates, Becky, is that we've just got too much oil, obviously not enough storage. And this is a temporary thing, but there's no doubt that storage is temporarily filling up over the next couple months. Or maybe over the next 6 weeks, we'll end up with storage levels near the tops and until we see demand come back. And that will be the opportunity then to see those inventories start to decline.
What happens in the meantime? What kind of carnage? Who gets hurt the most?
That's a good question. So if you have commodity price exposure and specifically, obviously, oil price exposure. So the oil producers that have direct exposure, what are they going to do? Their reaction is going to be, and a lot of them already done. You've seen actions taken by Continental and Concho where they, quote, shut in production. They turn the valves. They just don't produce as much in the field. So their volumes will come down. Obviously, if you don't have a hedge and you're an oil producer, you're going to receive less cash flow because clearly you're not getting much of a price at the various pricing points for it. So temporarily here, the oil producers that have commodity price exposure are the ones that will be the most impacted.
Hey, Rob, we spoke with Darren Woods, the chairman and CEO of ExxonMobil, a couple of weeks ago here on the program, and he laid out how important the dividend is. Take a listen to what he said at that point.
We have, over the decades, put a lot of priority on maintaining a strong balance sheet. We recognize, this industry has its ups and downs. It's a capital-intensive commodity business. Of course, over the longer term, to maintain that balance sheet, you've got to have projects and invest in advantage projects. So that is a key priority. And, of course, a lot of our shareholders are retail shareholders, people who depend on that dividend. So we've been pretty committed to maintaining that and if necessary, in the short term, using the balance sheet to support it. But primarily that balance sheet is to support the investments in these industry advantage projects.
Rob, I spoke with the company yesterday. They said they're still evaluating the market conditions, that they're going to be meeting. Generally, the board will set the dividend before the company reports earnings, which is next Friday, May 1st. What do you think happens with the dividend in this scenario for some of the big diversified companies that aren't as reliable on the price of oil, but still, watching what happened yesterday, it was kind of unbelievable.
Yeah, so I think, in Exxon's case, they've been paying a dividend for several decades, right? They really want to keep that dividend. They've got a balance sheet that they can support it for a while and probably keep the dividend in place, and like Chevron does as well for a little while. Actually, though, for dividend stocks, the Tortoise, our focus is on midstream, and these companies are resilient. They actually generate their cash by the volumes that are transported through the pipelines and don't have the commodity price exposure. And so for investors looking for dividend-paying stocks, we would really encourage them to look at midstream stocks, companies like Williams and Enterprise Products. These are companies that have been around a long time, have sustainable cash flows, even in this market environment, and can sustain dividend yields that are pretty high right now. And investors are looking for dividend yields in this market, I think.